cap rate, that's an interest rate based on some farm interest rates, and it comes from the Chicago Federal Reserve, and so we've got the cap rate in there. And so what do? You take the cash rent, you divide it by the cap rate, and that's the cash rent market value in use. You take the operating, divide it by the cap rate, that's the operating in use. You average those two together, you look at all 6 of them, you drop the highest number, you take the remaining 5, you average it together, and you get the average market value in use for base rate, preliminary base rate of 2640. Now, under the old system, we stopped right there, and that would have been the number. 2640 would have been the starting point, the base rate, and then for each acre of land, we would look at the productivity index, which tells you how good is the land and the soil type for growing corn, and the index ranges from 0.5 to 1.29, I think it is. And we multiply that factor by the base rate, and that means that more fertile land is taxed higher and less fertile land is taxed lower. And then we sometimes subtract off an influence factor, which is a percentage reduction for land that floods frequently or has a steep grade or is covered with trees or something like that. That would interfere with the productivity of the land for growing corn, even if it is a soil type that should be productive. So that's how it works. We've got the base rate. That's the thing that began to increase the assessed value of farmland. So you get that 2640. Well, the new system, 2 modifications, says this, or the 1 modification that's important here says this. 2640, how's that compared to the existing base rate? The existing base rate is 1850 for 2019, or 2018 it's 1850 for 2019, the one we're trying to calculate. The existing, or the average market value in use is 43% higher than the existing base rate. If that 43% number is higher than 10%, which it is, then look at the cap rates right there. You replace the cap rates, all these cap rates at 4 and 5, you replace them with 8. Now if you replace 4% in the denominator with 8% in the denominator, the quotient is going to come down, and so it does. And so what happens, we put the 8% in there, we recalculate everything, we add it up, it comes out to 1610. Add it up, average it out, it comes out to 1610, which is a 13% decline from what it had been the year before. Now what we've done, Tamara and I, what we've done is to take a look at projections of what commodity prices are going to be, and what yields might be, and what rents might be, and what interest rates might be, and have looked ahead to see if we can't take a guess as to what's going to happen to the base rate of farmland over the next several years. And that's what the graph beyond the black line says. If you take a look here, actually, if you take a look at the numbers in the right-hand column, what's the next one we're going to drop for tax year 2020? We're going to drop 1881, and we're going to add the 2018 number. What's the 2018 number going to look like? Well, we don't know yet. It's probably going to be something like 994, 1550, or 1256. We're certain it's going to be lower than 1881. So we're going to eliminate the 1881, and we're going to add in a number that's lower than 1881. That will drive down that average once again. And we think next year, for 2020, we'll be down to 1450. The year after that, we'll be somewhere in the neighborhood of 1250 or 1300. And from then on, we'll be bouncing up and down in the 1200 to 1300 range. Now, that's if nothing significant happens to corn prices and bean prices and yields and all of that. So we're looking far ahead. Nobody knows what's going to be going on 1 year out, let alone 10 years out, but given the projections we've got, that's where we think the base rate of farmland is headed from 2050 in 2015 and 2016 to about 1220 in 2029. So about a 40% decline altogether over that period of time. And that will reduce the tax bills of farmers. Now, in Washington County, this is likely to have bigger effects than just that. Now, here is on the left there, a pie chart for Indiana net assessed value by property type. And you'll see 38% of the taxable assessed value after deductions, net assessed value. 38% is business and real personal property for the state of Indiana. 34% is homesteads. 18% is other residential, mostly rental housing. 10% is agricultural business and land. In Washington County, 39% is agricultural business and land. And of that 39%, probably about 2/3 of it, maybe as much as 3/4, is farmland. So what happens if the value of farmland goes down by 40%? And it's really important in the tax base of Washington County. Well, remember how this works. We calculate the tax rate, and what happens? Net assessed value goes down. The maximum levy keeps going up, so we continue to raise the same amount of revenue. You take the levy, you divide it by that lower net assessed value. What happens to the tax rate? The tax rate goes up. What happens when the tax rate goes up? Let's take a look at those tax bills again. Only this is just a comparison in Madison Township and Salem City. Madison Township for the $83,000 home, Salem City for the $666,000 home. And let's just say that the tax rate goes up by 10%. And I don't know, in order to figure out how much it would go up. It's a seriously detailed and data-heavy analysis, but let's just see what happens when the tax rate goes up. Because we know the tax rate has to go up as assessed value comes down. So what happens to these taxpayers, these homeowner taxpayers? Well, if we redo the calculation, we've got the same assessed value, taxable assessed value, $21,700 in Madison Township. The tax rate goes up from $1.73 to $1.91. That's a 10% increase. Gross tax bill goes up. We subtract off the credit rate, and the credit subtraction is a little bit higher than it would have been before. The tax cap stays the same at $830. The tax bill in rural Madison Township goes up from $325 to $357, $32 more. If farmers pay less and we collect the same amount that we did before, someone else has to pay more. What happens? The tax rate goes up. Yes, farmers pay at that higher tax rate, but their assessed value has gone down even more, and the tax rate has gone up. So their tax bill goes down. The tax bills of everyone else, in particular rural homeowners, because that is everyone else, their taxes go up. What happens in Salem City? 10% increase in the district tax rate in Salem City, 370 to 407. It starts higher, it goes up even higher. We've still got that tax cap of $1,660 though. So instead of actually paying more, the tax cap credit goes up. And what happens? A $242 increase in the tax cap credit, that taxpayer doesn't see an increase in taxes at all. Still at their cap of $1,660. What has happened instead is that all of the units of government overlapping Salem City have lost revenue, have lost more revenue. Two possibilities from the declining value of farmland. Yes, farmers will pay less. Others pay more. Certainly in rural areas, others will pay more. Local governments will lose revenue where taxpayers are at their tax caps. So this is a distinction that needs to be made. If you're out in a rural area, and the tax rates are already low, and yeah, they're going to go up, but they're still going to be under $2, and that means that nobody in particular is at their caps, which means that all the non-farm taxpayers pay more, and the local governments collect that revenue. In the city, the tax rate goes up, but lots of people are at their caps, so they don't pay more. In fact, they pay a smaller part of their total tax bill, and the local governments lose that revenue. What's happening in the city is farmers who had paid are now shifting taxes to homeowners that don't have to pay. But if you've been listening, you know there's one thing I just skipped over, and that is how important is farmland in the Salem taxing district? How much farmland is in this town? Not very much. Farmland may be 39% of the whole county, but it's a much smaller share of the particular Salem taxing district. Now remember, part of the tax rate that people in Salem City pay is the county rate. And the county rate will go up because 39% of the county is agriculture. But the city rate probably won't be affected much. And the school rate, because it's basically the city, won't be affected very much. And so it may be that lots of people are at the cap, and there may be revenue losses for those units overlapping Salem, except their tax rate won't rise very much, because the city rate won't go up, and the school rate won't go up. And so what you've got here is a situation where you need two things to happen for a local government to lose revenue from the declining value of farmland. You need farmland to be really important in the tax base, and you need lots of taxpayers to be at their caps. Well, in rural areas, farmland is important, but not many taxpayers are at their caps. In urban areas, lots of taxpayers are at their caps, but farmland isn't very important. So I'm thinking that probably in Washington County, revenue loss is not likely to be particularly severe for the local governments. But the main effect will be in rural areas, farmers pay less, everybody else pays more. Now, where would you find someplace where someone might be affected? If Washington County had a single countywide school corporation, as some counties do, then both the county rate and the school rate would go up with the drop in farmland. And in the city, where lots of taxpayers are at their caps, the tax rate would rise significantly, and the units of government overlapping the city would lose revenue. But I don't think that's the case here in Washington County. So, what did we find out? How do you assess the possible effects on local government of the declining value of farmland? You need to know how the tax rates are calculated. You need to know about how the tax levy is determined. It's not simply the tax rate times assessed value that we set the levy and then calculate the rate in order to raise that amount of levy. You need to know how important is farmland in assessed value, which is the denominator of the tax rate. You need to know that the tax rate times each individual property owner's property is the tax bill, but subject to the tax caps, which apply when rates are particularly high. If you know all of that, each step of the way, you can figure out what's the impact of a policy change, like revising the formula for farmland assessment. What's the impact of that policy change on local governments and on taxpayers? And that's what we have to say about property taxes in Washington County. Are there any questions? Or have I bludgeoned yet another audience into submission? No, apparently not. Yes, sir.
I was on a committee at one time with Kendall Cole, which was the commissioner in LaPorte County. And whenever you were talking about these property tax value tax rates, you know, he was hanging his hat on was that they had some of the lowest property tax, on them because they were putting more on the income tax.
Mm-hmm.
It's Jasper County. So they have.
Well, was it Jasper?
Jasper, yes, that's right.
In there. So, you know, when we looked at that, there was different things in there. We looked at it surrounding county. We had Orange and Harrison County both had casinos.
Yes.
And now, Orange County says that they're not benefiting so much from the casino as maybe what Harrison does. Now, Washington County gets to participate in some of the revenue generated in Harrison County, but not in Orange County. But the observation that one of the guys that made in Orange County was that they've been stealing away from, you know, so much of the government and keeping their property tax base low that they've got themselves in a pinch, you know, as far as revenue to absorb, you know, the infrastructure that's needed by the people in Orange County. Now, I kind of have a little problem with that when I go through French Lick and Orleans and Paola and see streets and sidewalks, you know, being all refurbished.
Mm-hmm.
I don't think that particular version has been brought forth to them very well of how much importance that casino is.
Yeah, you know, there's two things. One, the casino provides revenue directly to the local governments, and it is true that other counties share in it as well. But the counties where the casino is located get the primary revenue from those casinos. Now, I looked up because I had it on the card here. Maybe this is the card you wrote out. Harrison, Orange counties have casinos. Average property tax rate in Orange is $1.76, which puts it, where is it? At the 25th percentile. And the average in Harrison is $1.34, which puts it among the lowest tax rates in the state. And I know Ohio is also Ohio County, where they've got one too. It's got maybe the second lowest tax rate on average in the state. So there's no doubt, especially casinos in rural areas. Now, you know, Lake County's rates, despite the fact that they've got 3 or 4 casinos, hardly affected by that amount of revenue just because they're so big. But a rural area likely be affected a lot. Now, back in the 90s, I did some of the fiscal impact on the riverboat proposals. Remember when the riverboats were, when we said, hey, we're going to have riverboats, the different companies came in and made proposals about what they would be. And I remember for Ohio County, for Vivi, the county seat, their annual budget was $300,000, and they were going to get $8 million a year from the casino. Now that'll affect your property taxes, right? So low property taxes. So not only are they getting additional revenue, but by buying down their property taxes, they are losing less from the caps. So it's kind of a double benefit from having those casinos. Yeah, Tamara, do you have a...
Well, and I think the other thing is Orange, Harrison, and Jasper is they all have higher assessed values per capita too.
Mm-hmm.
So yes, they're levying less, not Jasper necessarily, but they're levying less with the property tax.
Right.
But they also are dividing that over more assessed value in Washington.
Yeah, you got to remember that as well, right? There's the numerator and there's the denominator. Let's not forget the denominator. We may be able to buy down that numerator. But if you've also got a bunch of property to tax, and maybe some of that property is the casino itself. So if you've got the casino in there, they pay property taxes as well. That's high value property, and if they're smart, they haven't given them any tax breaks on it either. And they've paid the property tax. So in a sense, really 3 positive benefits from having a casino if you happen to have a place to put a riverboat.
You mentioned assessed value. We were having this discussion earlier. Obviously, assessed value is a driving component in all of this. Do you have I realize it's a whole host of factors, but can you summarize how assessed value is calculated?
How assessed value is?
Calculated.
Oh. Well, you know, the Supreme Court's decision in 1998, what did they say? They said that assessed values must be based on objective measures of property value. In the old days, when you had the old true tax value system, it was a set of rules and a manual that was this thick. They went through the process, they came up with the assessed value, and the only way to know whether the assessed value was right or not is, did they follow the rules? There's no way for a taxpayer or a property owner to know whether the assessed value is correct or not. Under our market value and use system, the idea is to allow the taxpayer to audit the assessor. That is, when you look at the assessed value of your house, it should be familiar looking in the sense that it should be something like what you know your house is worth, how much you can sell that house for. You know, in your neighborhood or the neighboring houses, you know what they've sold for, if they've sold. You've got some idea as to what that selling price is. That number should be something like that. If it's within plus or minus 10%, the assessor says, okay. Now, the Department of Local Government Finance every year does what's called a ratio study. And they take the houses that have sold and they compare it to the assessed values of those houses to see if they're close. To see essentially if the predictions that the assessor has made about possible selling prices are anything like accurate. And if they're not accurate, the DLGF is opposed at any rate to have the assessor do it over, or at least assess some sort of penalties on on the assessor to try to create an incentive to keep those assessed values correct. Now, the problem with that is, at least in the past, is the penalties for doing it wrong were so severe that the DLGF was loath to interfere with the budget process to that degree. But they do these studies, and they do them in order to try to keep the assessor's feet to the fire, to keep the assessed values close to the market value, the potential selling price of property. So that's the ideal. And for homes, when there's a lot of sales, you can do that. You know, for business property, it gets harder, because not only doesn't it sell so often, but how do you compare this factory to that retail strip to that commercial apartment? Right? They're different, widely different kinds of property. So for that, a number of different methods are used. One of them is to figure out construction costs and subtract depreciation. Another is to take a look at the rents that are earned and divide it by a rate of return. And we get into lots of arguments about what is the appropriate kind of, or what is the appropriate value for assessing that kind of property. So that's it. Now, for business equipment's a little quirky. Because of depreciation, most business equipment gets put into the 8%, or the, I should say, 8-year category, where you take the cost of buying that equipment and you start to subtract depreciation as it gets older, and you get, after 8 years, we think of it as fully depreciated. Though we have a 30% floor on personal property and business equipment, that is, a company's total amount of business equipment must be at least 30% of its original cost, whatever it might be. The business objects to this 30% floor, and a lot of lobbying goes around that. So what do we got? We've got the purchase price or initial cost less depreciation of equipment. We've got construction costs less depreciation for business buildings. We've got predicted selling prices for homes. That leaves farmland. Farmland is, well, it's called use value. That is, we say, let's take some numbers about, as I showed you in the formula, rents and prices. Vision said if you're using objective numbers, and objective numbers go into this formula, then it's okay. And so that's, in a nutshell, is where those numbers come from.
Got a quick follow-up question.
Yeah.
So, in a scenario where less revenue is coming in from farmland, thereby dividing that proportionally to other entities, et cetera, et cetera. And let's say, for example, if I'm looking at page 8, the city of Salem, for example, there's a large percentage of people at their caps, but you still need the revenue. How does a revenue-hungry politician obtain that money? You still got bills to pay, but you don't have the money coming in. So what happens?
Well, that's and you know, statewide, something between $800 and $900 million is knocked out of property tax revenue as a result of these caps, and basically local governments have just had to deal with it. You know, what are the options if you're losing 20% of your levy to the property tax caps? Well, the DLGF these days makes an estimate in advance of how much each unit of government is going to lose, and there's some argument as to how good the estimate is, but at least recognizing that in the budget process, yes, you can levy this amount, but you're not going to collect it. It's not going to come in. You'd better make an allowance in your appropriations for the fact that you're not going to receive your full property tax levy. It's a quirk of the budget system, if you think about it. The city can't know what their tax losses are going to be until all the other units of government set their rates. And all the other units of government do their budget. But all the other units of government can't know what they're going to receive until the city does their budget. So we imposed this tax cap system, and in a sense, really messed with the budgeting process in Indiana. But again, the DLGF comes forward and says, all right, here's our guess as to how much you're going to lose. And so you basically have to say, yeah, we've got the maximum levy, we can't go above that, and we've got the tax cap losses, we got to take that into account. We had better do appropriations under that combination of revenue. So we basically have to cut appropriations. So where do you get extra revenue? take everything you possibly can off the property tax and charge for it. It used to be an awful lot of local governments would use the property tax for trash collection. But you can charge a fee for that. An awful lot of folks switched from property taxes to charging for fees. Local income taxes are another possibility. I believe, if I'm right, if I remember right, Washington County reduced its property tax relief rate by a quarter point and raised its expenditure rates by a quarter point. That is additional revenue for local government. So the local option income tax, local income tax is another possibility. There are a few other local option taxes, the wheel tax, hotel motel, restaurant taxes are other possibilities as well. But I think the response throughout most of Indiana has been, we've got to reduce appropriations. I think that's been the main thing that has happened.
Well, and I guess for schools we have seen this in a couple of schools, you just get taken over, right?
Well,
In Muncie and
one can argue, and boy, do they argue in Muncie. What happened over there? The state has taken over, Ball State has now essentially taken over the Muncie Central School District. The legislature dismissed the elected school board and turned it over to Ball State, and Ball State has now appointed a school board. And they are going to make the difficult decisions of closing schools, laying off teachers, and that sort of thing. So yes, you know, one wonders whether we're going to run into that sort of thing more and more. Now, you know what? I recently heard a discussion of this. The state is coming up with some fiscal indicators, which should be leading indicators, fiscal indicators of who's getting into trouble. You know, could we have looked at Muncie schools 5 years ago and said, well, you guys are on the way to being in trouble? And if so, could we have said, here's some red flags, school board, you really need to act. That's the idea. So they're working on those things sometime by the end of the year. They're supposed to have a prototype of what these might look at. And I think that's going to be very interesting to see what numbers are they going to use to combine to try to give some leading indicators. But you know, what can you say about the tax cap credit losses? You either cut spending or you find some other revenue. And that's what you can do. Or no, may have one money. You want to become more efficient, right? More bang for the buck. Reorganize in a way that delivers the services for lower cost. And I'm certain efforts have been made in lots and lots of places to do that. There are probably physical limits as to what can be done in that range, but boy, it sure is an incentive to look for any efficiency that you can find.
I noticed on the first table, you guys have net assessed value.
Yes.
In this one. So what exactly are you deducting from gross assessed value to get to this number? So what?
All of the deductions. So if you take a look at the tax bill at the end there,
Okay.
the big deductions are the standard deduction and the 35% supplemental deduction.
Okay.
But it's also abatements, TIF is subtracted out, any tax increment finance district assessed value is subtracted out of that. But by far the biggest deductions are the homestead standard and the homestead supplemental.
So you are deducting out abatements in this number?
Yes.
Okay.
Yes.
All right.
So
That's-
basically anything that is not taxed is not included in that assessed value. And so when they calculate the tax rate, they say, let's take everything we can actually tax, take the levy divided by that, that's the rate. So that then the rate times everything we can actually tax should generate the rate. Yes?
I have a comment and a question. One of the questions, a comment to follow up about how you increase revenue.
Mhm.
In addition to raising rates, it would also be beneficial to think about population growth, income growth, and there are things to be done at a policy level for a community rather than increasing.
Yeah, if I can say something about that, if you think about the way the tax caps work now, if you're at your cap, the only way to raise revenue is to increase assessed value. And so whatever you can do to attract population, you're right, for more housing, for more industry, more commercial property, that sort of thing. Ultimately, that's make the pie bigger. Basically, ultimately, that's the way that you can do it. Now, you know, that's a lot iffier than cutting expenditures or finding another tax. But, yes, I would agree that if you figure out a way to do that, if that's what you want to do.
And then the question I have, can you talk about the fiscal impact if the school system is going to do a large project and needs to take out a bond? What's the fiscal impact if you do a referendum or you don't do a referendum to those that are potentially in the city limits that are at their caps versus those that are outside of the city limits and not at their caps? What's the
All right.
fiscal impact there?
And this is why I call the tax cap the Rubik's Cube of Indiana finance, right? So here go the mental gymnastics. Okay, most important thing, referenda outside the caps, no referenda inside the caps. All right, so first of all, are you allowed to do a big project and not do a referendum? Technically, you're not. So that if the project is big enough, and there are limits in statute as to how big it needs to be to go to referenda, if it's big enough and you get the 500 signatures from the taxpayers, you got to go to referendum. Now, could you cut the thing up into pieces, make them all small enough so that you wouldn't have to go to referendum? Well, there's statute against doing that, but I don't know that anybody's checking other than lawsuits. Right? That's the kind of thing that gets checked in the court system by lawsuits. So I'm pretty confident that that has been done. But if you're going to do that, you'd better have a pretty good justification why this project and that project should not have been combined into one big bond. So suppose you can do so. This is assuming that you've got the choice. You can do it by referendum or you not do it by referendum. If you do it by referendum, and the people who are at their caps, they pay extra. The people who are not at their caps, they pay extra. Everybody gets treated by the same because it's outside the caps. If the caps didn't exist and the referendum raises the rate, everybody pays the extra rate. It's interesting to note, by the way, we have tax increment finance districts. The referendum rate applies to the TIF assessed value. That is a thing that came out of West Lafayette, actually. The controversy came out of West Lafayette. Somebody noticed that if the West Lafayette School Corporation had passed their referendum, which they did, the TIF district was going to get a whole bunch more revenue because it's based on the existing tax rate. And so the voters were saying, hey, wait a minute, I'm voting in favor of giving West Lafayette a bunch of revenue, and instead, or in addition, I'm giving a big chunk to the TIF district. And so they said, nope, from now on, the referendum rate applies to the TIF as well as to that. So you get extra bang for your buck out of a referendum rate that you don't get out of a rate that you put in that doesn't pass by referendum. So suppose you don't go pass by the referendum, rate goes up. You're already at your caps, you don't pay anymore. You're outside and you're below your caps, you pay more up to your cap. And so the folks outside pay more and the folks inside pay less, and the local government receives less than the total amount of revenue, which may be of concern to the people who lent you the money. And now you're actually going to be able to, so in setting your rate, you will have to know how much additional revenue you're actually going to get. But it means that the folks out in the rural areas outside of the cap will pay a bigger share of the total of what will probably have to be a higher rate in order to actually pay off this bond, if it's the same size bond as with the referendum. They'll actually have to pay a higher rate than the folks at their caps in the city. Now, the folks in the city who are below their caps, there's that thing extra. The folks who have higher caps, business property in particular, at the 3% cap, if the rate is going up from 250 to 280 or something like that, businesses pay as well, and that would be a concern for your economic development situation as well. I think, does that cover it? I think that would be the situation. So, it really is a very interesting choice in terms of revenue raised and tax incidence, or who pays, choosing either to go to referendum or not go to referendum. Yeah.
Two questions. One is follow-up to that. Then we had a lot of questions when we've had some recent discussions of all three of our school systems have needed some major expenditures to happen recently. And so, referendum versus no referendum, everyone kind of has a different view. But in all generality, referendum gives the most equal portion of the tax distribution to everyone then, right? Because the tax caps are not in play. like, as fair as it can be, basically.
Fair is in the eye of the beholder. And somebody's at their tax cap, says, I already pay so much, you're gonna make me pay more? They pay hardly anything, let them pay for it. You know, so I'm not gonna be a judge of fair,
Well, I
but
guess
what you're
fair's not a
saying
good
is
word, but the most equal distribution.
equal distribution,
of
yes.
it. Okay,
I would agree with that.
That's
I would agree with that.
sorry. Fair was not a good word. I was like,
I'm
fair's
sensitive
not
to
really-
that because I'm not
fair's
about to
not really
take
a good word.
sides.
Okay, so, no, that's good, it's okay, I don't need sides on that. And then, second question would be, do you have, well, I guess it's kind of a two-part question too. You know, something else that came up, and you've kind of mentioned it a couple times, is that, you know, it's not really easy for one district to know what the other is doing. Is there something that we can do locally that would increase that communication to know that what schools have coming up, what the county has coming up as expenditures, what the city is planning, you know, things like that? Is there something that areas can do that maybe we're not already thinking of that can improve that communication so that everyone's kind of well attuned to what is in that pie? Because at the end of the day, it's still one pie that we're all working out of. So, and then also, is there something that we can do to improve this, I guess, this constant chaos that we're in at a local level? Is there something, you know, when you, it seems like to me, when you improve or increase population, that means you also have more services that you're applying or you're having to offer then too. So it's almost a double-edged sword with bringing in more population sometimes, so.
Okay, that's a lot of questions.
Sorry.
So working backwards from the last one, yeah, you know, fiscal impact is what we call that. You get new population, you get more houses, you get more business serving that population, you get more employees for more businesses, and you deliver services to more school kids, to more adults, to the businesses that are created. And when you undergo development, you really ought to at least try to take a guess as to how that's going to balance out. Remember that maximum levy increase. Well, I remember Benton County is just northwest of Tippecanoe County when they got their wind turbines. 1,000 wind turbines in this rural county with only 8,000 people, you know, and the assessed value skyrocketed, and the local government official says, well, what are we going to do with all that revenue? There was no extra revenue. The maximum levy increased 3.5%. They got an extra 3.5%. Tax rates went way down. And so what happened was the tax bill, the tax revenue they received from the wind turbines replaced revenue received from existing taxpayers, and the additional revenue that came along, basically the same amount. Right? So when you're thinking about fiscal impact, that maximum levy, something, you know, it's tax relief that we just don't think about as much anymore because of all the excitement over the tax caps, but it's still there, and it is still limiting the amount that can be raised. So that's one thing to consider on the tax impact. And I'm struggling to remember that question because it was so interesting. I wanted to talk about it.
Sorry. If we could do anything else at like a local level to increase that communication.
You know, when the tax caps came in, all of a sudden everybody's budget was dependent on everybody else's budget. Right? If you share taxpayers in the taxing district, what you do, what the school does, depends on the county. What the county does depends on the city. What the city does depends on the county and the schools. And, you know, starting then at about 2008, all of a sudden I was going to meetings where for the first time ever, it seemed like the county commissioners and the mayor and the school superintendent were in the same room together. And sometimes it was this fuzzy love fest. And other times, it wasn't, you know, because it is a fixed pie now, right? And then, you know, I flashed through it because I was in the interest of time, but you probably saw there was a pie there, and that's what we're trying to explain. It's a fixed pie, and there's a maximum amount of property taxes that can be raised by this fixed pie, and if you're at your cap, and one unit raises more, the other unit gets less. Right? And so, you have to be careful that now there's no place in Washington County outside of the Salem district where that is true. But inside the Salem district, to some degree, if one of the units raises more, it subtracts from what the other units can raise. And so especially in the Salem district, those units that overlap the Salem district, communication's probably would be pretty important. So the superintendent and the mayor and the county commissioners in particular, and the township trustees and the library director ought to be in touch with one another during the budget season to say, hey, here's what we're considering, here's what's likely to happen, here's what might happen to our tax rate, and that's the important thing. There's no formal mechanism for this to happen. This is just something that has to happen if they want to communicate. So, you know, it could be that some local group is well positioned to bring them together. You know, you can think of all the public service groups that there are in a community that might make that happen, or they might be in touch on their own. They all live here. All they run into one another. But again, it's informal. Tamara, what?
Well, I was also going to say the maximum levy kind of also works against collaborating per se.
Okay, so if you were really at each other's throats, right? You can gain revenue. So, you know, what would you want to do? I want to increase my revenue, but I don't want to penalize my taxpayers. I can raise my rate, increase the slice of the pie that I receive, decrease the slice of the pie that everybody else receives. My taxpayers still say the same amount. They don't care where the money goes. They just don't care how much they pay. I get more money, everybody else gets less.
Which is, but, I mean, we've had city government that thought that they would give or decrease their
Oh, yes.
tax rate.
Yes, okay, so opposite, right? I ran into this in Fort Wayne as well. Had some thoughts in the city that, hey, let's raise less than our maximum levy, right, in order to give our taxpayers a break. Well, they raised less than their maximum levy, and so their taxpayer, if their cap was here, their tax bill went from here to here. They still paid their cap amount. No reduction in taxes. What happened instead is Fort Wayne decided to collect a smaller part of that pie, and everybody else got more. They basically handed money over to the county, and boy, Fort Wayne don't like it. So it works against taxing it less than your maximum. Our Rubik's Cube does. Our tax caps do. So a lot of different things, but you know, I think having local officials talk to one another once in a while is a good idea, but it's an informal thing. Yeah.
You made a comment about Fort Wayne and it's happened at Evansville where the cities have gone in there and have tried to annex as much as the whole county.
Yeah.
And so can you talk a little bit about the philosophy on that and what the ramifications are on city versus rural?
Well, you know, the rules on annexation swing back and forth. You know, on the one hand, I think anybody can see that if the city's boundaries are too narrow and the people living outside the boundaries are benefiting from city services, whether they're outside of the boundary of the city, expanding the boundary of the city to include the people who are actually benefiting from the services, so that those people will actually pay for the services, could make sense. On the other hand, expanding the city out into the cornfields, anticipating development that might take place sometime over the next 100 years, might be a little extreme. All right? So on the one hand, yeah, we want to allow cities to do this. On the other hand, we don't want to allow cities to do it too much. And the legislature goes back and forth, adjusting the rules one way or the other to try to work out a kind of compromise. You know, I guess we've got a rule in there now that says that annexation by cities of farmland does not raise the farmland property tax rates. I'm a little vague on that rule, but I believe that's in place, so farmland may not be affected that much. But let's face it, if the city expands its territory and raises the tax rates on their taxpayers, it will add revenue that the city collects, and if anybody's at their caps, subtract revenue from all of the other units. And so what we've done with the tax caps is create a revenue penalty for overlapping governments from city and town annexation. it's another of those type of consequences of the tax caps. And I'm not certain we're anticipated, but pretty clearly that's how it works. There was another one. Yes, sir.
If there creates this penalty, why don't the counties fight annexation then?
Well, the counties could, I guess, and this is where the rules, what tools have they got? And you're pushing beyond my knowledge of how the annexation process works. To the extent that counties have some tools for fighting annexation, they certainly ought to, be aware of what the city is planning and do it, and, to the extent that they can do a kind of fiscal impact. And, I know consultants are expensive on this sort of thing. The county government actually has all the data that's necessary to figure out what would happen if the tax rate were to go up. Often the software isn't really set up to do policy simulations. And I know I've talked to treasurers and I say, you can do this policy simulation, and they get a kind of deer in the headlights look because they're afraid they're going to stick some simulated number in there and forget to take it out when tax billing time comes and mess up the whole billing run. But one thing is, if your software vendor can set you up to do policy simulation and you've got somebody who's got the time and inclination and skills to run these kinds of simulations, boy, it's a great idea to do that kind of thing. Bring that stuff in-house. And again, it's rare for counties, especially rural counties, to be able to do that. But boy, it sure would be a good idea to try to figure out, hey, if the city annexes this territory, what's going to be the revenue impact on the county and on the school and on everybody else?
But I happen to live in an area where it's annexed. And none of the services that we get were provided by the city. We were paying for those services ourselves. The only thing we got by being annexed was a higher tax bill and an occasional city cop drive through the subdivision. That's the only visible, ultimate benefit is both the county deputy, not the city cop. That's it. Everything else was already a service that we paid for. And so I'm sitting there thinking, the county really lost. And the county was asleep at the helm in that situation, because this was several acres and several homes that the city just got a lot more revenue from.
I leave that as a comment rather than a question. Yes, sir.
Can I speak in real quick? I'm sorry, Max. I always get Max off. He knows he's used to it. I'm going to go ahead and hand out the evaluation while we're doing some of these questions and answers, because I know some people need to be getting on to work and it's going past the hour, like you said. So thank you, Larry, John, and Tamara, for coming down here and doing this for us. I hope that it's been helpful to you. I know it helps me a lot, and I go to a lot of all of the on-level government webinars, and today some things kind of came together for me that I haven't posted, so I hope the same for you. I'll be sending out information about the next on-level governments, and I'm hoping to have as many here as was today at the next one. But John is going to pass out the evaluations on this side. I'm going to pass them out on this side, and you guys fill them out accordingly, and just turn it back into me. But keep asking the questions as long as Larry and Tamara and John are able
How about a couple of more, and then I'll hang out for a little while.
I'm sorry we went a little long, but I think it's a good discussion.
We can break and you guys can ask us questions, and that is a little easier.
Yeah, that's right. I know for undergraduates in my classes, a lot of them simply won't go as long as somebody is still asking a question, because that question might be the one, right? So, feel free to leave if you need to. But question?
Yeah, you mentioned kind of in passing that the TIF districts comes out of, reduces the net assessed value. So does that mean that the TIF districts create more of a tax cap conflict?
Yeah. Okay, so what about TIF? TIF districts, if used appropriately, won't have an impact on overlapping revenues. And by appropriately, I mean satisfy, and this is in legislation now, it's in the code, satisfy the but-for test. And that's lawyer jargon for the development that occurred would not have happened but for the TIF district. And so if you hadn't drawn that TIF district, the development never would have happened and that assessed value wouldn't be there to tax. Having drawn the TIF district, the development did happen. Yeah, the additional assessed value is taxed by the TIF district and not by the overlapping units, but the overlapping units are no worse off than they were before, if that's how it works. Suppose, however, that you TIF an area that would have developed anyway. In that case, you have now taken some tax base that would have been in there out of the tax base. The tax rates would have been lower than they are, because there would have been extra assessed value. If the tax rates had been lower, fewer people would have been at their caps, less revenue lost by local governments, as well as lower tax bills for existing taxpayers. So yes, I would say that caps mean that you should be even more careful about the use of TIF districts and making sure that the TIF district really is necessary, and that means the financing that TIF provides and the infrastructure that it creates. Both those things necessary to make the development happen. Any question? No? Yes, sir?
The numbers you run before on your webinar thing, you had projected like 10 to 20% tax increase on other taxpayers.
Mm-hmm.
And that was in general. Now that you've had a chance to look at the county's numbers, and the tax rate for most of the districts like 1.78.
Yeah.
Like 13% would be enough to start hitting 2% and start capping a lot of this out.
Right.
In the next 2 years, based on the trend you see on the farm grid based on, is it going to surpass that 13% drop? Is it going to actually bring the 2% caps into the county?
All right, let's do it. So 1850 now, down to 1200. That's about a 30% decline. 30% decline of about 25% of your tax base is 3 times 2 is about a decline of 8% of your total tax base. Total tax base goes down 8%, and that means an increase in your tax rate of, let's see, 1 over 0.92 of, well, we can just say 8% approximately. So I would say the average tax rate probably going up in the neighborhood of 8%. In the city, it would be less than that. In the rural areas, it might be more than that. But it's hard to see it being so much more than that your rate gets up that high, because remember, it's not static, right? Because so assessed values will be rising, presumably, generally over time for all the other kinds of property. And so that means that the 8% impact of the farmland will be mitigated to some degree by the general increase in assessed value. Of course, there's also the increase in the maximum levy of 3.4%. And you get the idea as to why it's so hard to make that prediction. But you know, a number in the 6, 8, 10% range sounds plausible to me just off the top of my head, which means you would approach but not hit 2. Yes?
Yeah, you were talking about how the change in the farmland assessment would affect Salem School because of, and I wonder if you knew, or about 25 to 30% of the rural part of the county is in Salem School. It's not just a school for Salem. So
okay, no, I did not know
it
that.
includes rural parts of that township, plus there's 3 other townships. So
okay,
it
so
seems
Salem
to me-
Schools has got some significant farmland, in other words.
Yes.
Okay, well that makes a
13
difference.
miles from Salem.
That makes a difference. Because remember, you know, the Salem City may not have any farmland, but if Salem Schools has farmland, and of course the county's got farmland, then those rates are affected. And that makes 2 of the 3 big rates that make up that $3.70 are significant. So knowing that, you'd have to revise it a little bit to say, well, it would be, it's at least possible that there might be some revenue impacts. And I say that at least possible because, I actually did, and it took days. The exercise took days of messing with the numbers, and I did it for Carroll County, just to see. And I did a presentation in Carroll County. That's a rural county just east of Tippecanoe East, right? Tamara's not east. And I did the presentation, and they had one, and they had a town that had a rate above $3. And I made the presentation, and I didn't know what to say about the numbers because I knew what the numbers were, what they looked like, what the dollar figures were, but I wasn't sure whether the officials who were there would think those were big numbers or not. So I wanted to present it without any adjectives to start with. And there was a superintendent back there, and I said, well, here's the revenue impact, and I gave him a number, and he said, well, that's just half a school bus. I'm not going to worry about that. So, yeah, the fact that there's farmland in the Salem School District is significant, but it's still not, doesn't say that the revenue impact will be so great that it would create serious difficulties for the school corporation. But, the only way to know is to run the numbers.
I would say that the effect is going to be, it's going to shift a lot of the taxes to rural homeowners. People that live in houses in, say, Little York or in the country, that don't own farmland.
Right.
Because so much of Salem is at the caps, that the farmland is going down, looks like,
Yeah.
this is like a narrow slice of people that's going to get maybe very large increases in tax rates.
Yeah, and when I ran the Carroll County numbers, the increase was about 10% on the rural homeowners altogether, which is, when you divide it up over several years, is enough to notice, but not like we experienced with the reassessments, for example, and not the shocking numbers that we experienced with the reassessments. The thing is, in Salem, the rate goes up for the Salem School Corporation the same in the whole district, the Salem, where the Salem district itself with the city, and then outside the city as well. So outside the city, yeah, the homeowner taxes will go up. Inside the city, that's where the revenue losses would take place. Other questions? I feel very well exercised. Thanks very much.
Okay, sounds good. Yeah. If you, August, probably, August. Oh, there you go. Sorry.
Okay.